Welcome to my video presentation for Monday, July 15. To view our full range of products and trading services, visit our website at investingdaily.com. Also, visit the website of our subsidiary, streetauthority.com. I'm John Persinos, editorial director of Investing Daily. Let's review the year's developments as of midsummer. A bitterly fought presidential campaign amid a sharply divided electorate, escalating racial tensions, a divisive Republican standard-bearer clamoring for law and order, assassination attempts of politicians and warnings of civil war, growing economic insecurity among the working and middle classes, national political conventions poised for street violence, increasing incivility and a coarsening of public discourse, worsening superpower tensions among the United States, Russia, and China. Yep, the summer of 1968 was a scary time. I was only 10 years old, but I vividly recall the images of urban mayhem on television. As I survey the similarly tumultuous events of 2024, I'm reminded of the often quoted malapropism of baseball legend Yogi Berra. It's deja vu all over again. And yet, despite today's dire headlines, I'm optimistic about the prospects this year for the economy and the stock market. By 1968, economic growth in the stock market had been rising with only minor hiccups for 2 decades. Prosperity would continue until the 1973-74 bear market, when stocks across the board got crushed. Today's bull market is about 21 months old. Do we face a similar day of reckoning? The fundamental and technical indicators say no. In a world where the stock market feels like a daredevil tightrope walker, the latest economic data has handed it a balancing pole. In this video, I'll show you how to keep from falling. The backdrop of slowing but still positive economic growth coupled with easing inflation has set the stage for continued strong performance in the equities market. Both the S&P 500 and the Nasdaq have recently achieved record highs, underscoring the market's resilience and potential for further gains. Take a look at the following chart. In June, the Consumer Price Index, the CPI, inflation rate declined to 3% year over year, marking the lowest level since March 2021. This downward trend in inflation bolsters consumer and business confidence. On the other hand, as this chart shows, the Producer Price Index, the PPI, saw an uptick to 2.6% in June, above the expected 2.3%. This rise was largely driven by increased wholesaler margins, which typically indicate robust end demand conditions. The uptick in the PPI was an unwelcome surprise, but the post-pandemic recovery isn't likely to move in linear fashion. Taming inflation has been bumpy, but progress is being made. With inflation trending lower, the Federal Reserve is likely to stay on course to reduce interest rates by the end of the year. The prospect of interest rate cuts by year's end helped drive the equity markets to yet another winning week. The Dow Jones Industrial Average gained 1.6%, the S&P 500 gained 0.9%, and the tech-heavy Nasdaq gained 0.2%. The MSCI EAFE, which measures equities in developed countries, rose 1.6%. The economy is decelerating but not lapsing into recession. The labor market, while still strong, shows signs of cooling. The unemployment rate has risen to 4.1%, up from its post-pandemic low of 3.4% and slightly above the Fed's forecast of 4% for 2024. An increase in unemployment could exert downward pressure on wage growth, which in turn may help keep inflation in check. Slower wage growth can alleviate some of the cost pressures on businesses, potentially leading to higher profit margins and supporting further stock market gains. It's a good sign that the S&P 500, as measured by the benchmark SPDR S&P 500 ETF Trust, the SPY, hovers above its 20, 50, and 200-day moving averages. The S&P 500 has continually hit new highs this year. The Nasdaq Composite also hovers above its major moving averages, driven higher by expectations of lower interest rates and the continuing mania over artificial intelligence. The New York Stock Exchange Advanced Decline Line, the NYAD, the NIAD, also has been rising, indicating greater breadth. The NIAD shows the number of advancing stocks minus the number of declining stocks. When major indices such as the S&P 500 are rising, a rising NIAD confirms the uptrend, and of course vice versa. The CBOE Volatility Index, the VIX, aka Fear Index, has been falling. It sits below 13, indicating a decline of stress and uncertainty in the markets. As a rule of thumb, VIX values greater than 30 generally show heavy volatility resulting from increased risk and fear. The onset of second quarter earnings season has brought with it high expectations. For Q2, the S&P 500 is expected to rack up 8.8% growth in the year-over-year earnings, the fastest pace since Q1 2022. This robust earnings growth is projected to be broad-based, with 8 of the 11 sectors on track to report increases. The broadening of earnings performance is particularly important because it suggests that sectors which have lagged behind, such as industrials and consumer staples, may begin to catch up with the technology and communications services sectors that have been leading the market. This diversification in earnings growth can create a more balanced market, reducing the reliance on a few high-performing sectors and spreading the potential for gains across a wider array of industries. Such a shift can enhance the overall stability and sustainability of market growth. The combination of easing inflation, robust earnings growth, and a cooling yet stable labor market creates a conducive environment for the stock market to thrive in the second half of 2024. Now let's take a look at the week ahead. The following key economic reports are scheduled for release in the coming days. Fed Chair Jerome Powell speaks Monday. U.S. retail sales, business inventories, home builder confidence index Tuesday. Housing starts, building permits, Fed Beige Book Wednesday. Initial jobless claims, Philadelphia Fed Manufacturing Survey, and U.S. leading economic indicators Thursday. Throughout the week, various Fed officials are scheduled to speak. Their words have the power to move markets, so stay vigilant. Well, that's it for now. Thanks for watching. Be sure to maintain a diversified portfolio, keep your emotions in check, and hit the mute button when the TV news is on.